Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing, and we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show.
Welcome, everybody, to another episode of the Tech Guys Who Invest podcast. Today, we have a special guest, Andrew Sather, to talk about investing in the stock market, maybe some misconceptions, some risks, etc. We're looking forward to the conversation with Andrew. Welcome.
Yeah, thanks for having me, Kevin and Adam.
Yeah, thanks for coming on the show. Really glad to have you here. Andrew,
Actually, sorry, I didn't mean to cut you off there. I actually do have a background in tech. I'm a electrical engineer by trade, so it's cool to talk to a couple tech guys.
nice, electrical engineer. Yeah,
That's
excellent.
fantastic.
We probably both work with several of you.
What do you do?
Yeah, so I'm an business agility consultant, so an agile coach.
And I'm a software sales
super
engineer, but I went to school for biomedical engineering, had to take a couple electrical engineering classes, and they were my least favorite engineering classes. No offense to you. It was just, I couldn't wrap my brain
I don't blame you.
around it. It was just so difficult for me.
I struggled to the electrical engineering 101 where we had to do circuits. I may or may not have had to take that a couple times.
Yeah, it's pretty neat. The hardware side's definitely fascinating. All the guys I work with are software developers, engineers, but hardware is really fascinating.
And as it pertains to investing, I think tech gets thrown around just as a word, and we start to think of kind of, I don't know, .com kind of tech where it gets associated and everything gets thrown in with businesses that are very high growth or don't have profits. In reality, we're going to have decades coming up where what we used to call tech is now called industrials, or what we used to call tech is now called manufacturing, because tech is such a big part of our lives now that what used to be called tech is no longer going to be tech.
Interesting.
Yeah,
way of looking at
interesting
it.
take on it. So, Andrew, do you invest in a lot of tech companies?
It's funny, I don't, but so I've been looking really hard at tech lately. The first stock I ever bought was Microsoft, and I basically bought it because rewind, this was all the way back in 2012. So I had never bought a stock before. I didn't know hardly anything about the stock market. And I just wanted to buy something. So I decided, why don't I buy Microsoft? I knew at the time, again, this was 2012, that they were coming out with a new console. I knew that basically everybody had some version of Microsoft somewhere on the computer. So I figured, sounds like a safe company. They have some cool products coming up. I'm going to buy it. And, to date, it's probably been the best stock I've ever bought. And I've upped the research and everything. And it's very hard to duplicate a stock like Microsoft. These days, I've been looking towards the cloud, and I'm kind of looking at IT. Particularly today, I was doing some research in there, and I think the big tech companies like Apple, Amazon. So particularly, I guess if we're going to go the IT route, you talk about AWS, Microsoft Azure, and Google Cloud. Those guys really get, I think, a lot of the attention on Wall Street, and you see them with the way that their stock prices are just through the roof, particularly since the pandemic. But I think there's a lot of pockets in there, because the way I invest, I try to buy things that are still relatively cheap. So even if a company is really good, has high growth, could be the most innovative tech, I still don't want to pay a ridiculous price on it. So I have to kind of pick my spots and look for pockets within, whether it's IT, whether it's semiconductors, whether it's software, whether it's networking. There are pockets in there where you can find deals with these tech companies, but you have to be careful because you don't want to end up in buying like an IBM, which has done nothing for the past 5 years, and now they're doing a spinoff, and that's not something that you hoped for when you bought the company 3, 4, or 5 years ago.
Absolutely. I agree with that 100%. There are a couple of things that we'll probably break down later in this episode, but one of the first things I wanted to ask is what would you say are the biggest misconceptions with investing in the stock market as we're talking about, picking tech stocks or things of that nature?
I would say, I guess maybe, we talked about IBM and how it hasn't done well. But really, if we talk about stocks in general, what IBM has done is more the exception than the rule. I think if we bring it back to the basics of what the stock market is, and the stock market is really businesses that are behind it. So if you go all the way back to like an economics 101 class, you know that investors give their money to an entrepreneur. Entrepreneur has a great idea, maybe has something that's small in place and wants to scale it bigger. So that entrepreneur will collect capital from investors and be able to scale a business. And so that's kind of conceptually easy to remember. I think it gets lost when you get to such a big scale and you're talking about the stock market because you just have these tickers that are moving all the time, numbers all across the screen. It's very, very exciting. But at the end of the day, these are businesses that if you look all around you, they're a part of our everyday lives and they're providing value to us and they're collecting profits along the way. So when it comes to the stock market, while you can be afraid to lose money, you have to understand that if you believe that over the long term, businesses will continue to serve people and make our lives better, then as they serve us, make our lives better, we will buy their products and services, which leads to profits for the businesses, which leads to their stock prices going up. The key there being going up over time. So while the stock market can be choppy in the short term, over the very long term, it follows what businesses do over the long term, and that's grow and make money.
Okay, that's a good way to think about it. Andrew, as someone who invests in the stock market, I assume full time professionally, what are the biggest mistakes you see other investors make?
Yeah, I guess I should clarify to what extent I am a part of the market. So I run a newsletter, a stock picking newsletter. I do a recommendation once a month, and that's how I make a living. And
Okay.
along with that, I am buying the stocks along with my subscribers. So I have a real money portfolio, and basically, it's the best way I found to put skin in the game for myself. So I'm sorry, I forgot what the question was.
Yeah, no, that's great. What are the biggest mistakes you see investors make?
Okay, yeah. So I also have a podcast where I talk to investors. So I get a lot of questions. Unfortunately, they're not as candid as I might be when I review some of my mistakes. Just maybe based on the type of questions I get and some of the things I can gather off of that, I think there tends to be sort of like I don't know, like an assumption that it's a one-time event. Like investing in the stock market's a one-time thing where I just need to find the best stock right now, or I need to find the next Amazon right now. And that's really not how the stock market works. And even if you were able to do that, that's not really how you build wealth over time. So our one of our taglines for the show is your path to financial freedom starts now. And so when we look at the stock market, we look at it as a place to build wealth and progress yourself to financial freedom. The key word in there is progress. It's something that you have to do over time. And really, if you want to do it sustainably, successfully, consistently, you have to set habits in place. And you really have to set that in first before you can even think about the stock market. So that means from an absolute basic level, you got to make sure that you're saving more than you are spending. You have to save something. So that means if you have income and expenses, you got to have a buffer in there. You can't spend more than you make. And then from there, you need to have disciplined, habitual saving and investing. So one way that that's frequently called is dollar cost averaging. And I like to use that approach for myself too, where you're just putting a set amount of money in the stock market every single month. I don't care if you get unemployed, times are tough, or you're making a bunch of money. Whatever it is, always pay yourself first, put that money into the market, whatever you set that at, and let that compound over time. And then from there, the stock picking itself almost becomes secondary, because really the compounding effect of a habit of constantly investing is really what drives wealth over the long term. But that would be the biggest thing, I think. Really, you have to look at it as a journey and not as this one-time lottery event. And once you can get past that mindset, it actually helps you with the stock picking too, because you start to look at businesses, not what's this business going to do for the holidays, how are their sales going to do next month, but is this business going to be around in 10, 15 years? Are they going to grow in that time? It shifts the mindset and automatically puts you towards success rather than being all short term.
Okay, you said a lot of stuff there that is really similar to how Adam and I approach real estate investing, where you don't get rich overnight. You're not focusing on that, and when it comes to making money, that you mentioned it, you have to have the discipline, the habits, the processes in place, and that profit becomes a byproduct of that. Like success is a byproduct of the habits and decisions and choices you make, right? Similar to that. So we love that you were talking about that. Now, you mentioned dollar cost averaging. What would you say the advantages are of dollar cost averaging?
So, when you look at the stock market in particular in contrast to the real estate market, I think I'm not going to rustle any feathers by saying the stock market's a lot more volatile, and you'll see those really big price swings. So where dollar cost averaging is nice is it will smooth out that volatility. So if you're doing the same amount of money every single month, it's really putting a automatic buy low, sell high into your process. Say you're putting in $100 a month. So if the stock market was at $50, you'd buy 2 shares. If the stock market went to $100, you're only buying 1 share. So you see how you're buying less when the stock market's up, you're buying more when the stock market's down. And all we did is just say, hey, we're just going to put $100 a month. So it's very scary to be in the market. And, if you started in the market in February and March of this year, bless your heart, it was a tough time to see your wealth evaporate like that in a very short time. But doing that and really spreading out the dollar cost with the dollar cost averaging mitigates a lot of that problem with the market timing, and automatically gets you set up where you can maximize your compounding over the long term.
That's great. I know some people are afraid to invest, and they feel like saving their money is a safer option. What would you say to someone about why they should invest versus just saving their money?
It's a great question. Yeah. So it's tough because, you look at savings rates today. I have an Ally high yield savings account. I stopped using it. It was really just as an emergency fund, but I saw that interest rate go from 1.5% to now it's at like 0.6% interest. So when you start to talk about interest rates like that, that's a very, very low return on your money. Now, to be clear, you always want to make sure you have a savings buffer before you start investing anything at all, because I think that's a good rule to have for investments in general. You need to invest with money that you can afford to lose. Not to say that you're going to lose it, but that you can afford to lose. That way, if the market crashes, you're not freaking out, having to pull out and sell at the very worst time. So you want to have an emergency fund in place. You want to have ideally maybe 3 to 6 months of savings. So if you lose your job, you have something to make up for that income. Once you have those things in place, then you can start to become aggressive with your money. Now, what I like about the stock market is that over the very, very long term, it's averaged around 10% returns a year. So we're talking like back to like the early 1900s. And really it doesn't really matter much what time period you're looking at, starting, ending. If you look at a long enough time span, you can get towards that 10% per year return. Now, if you start to think about how returns compound on themselves, it's the principle of compound interest. A difference of return, even of a couple percentage points, makes such a huge difference on your overall returns that it's very, very worth investing in something like the stock market or real estate versus just keeping it in a savings account where you're not going to make anything off 1% return a year or 0.5% return a year. It's just the math. If you just do the math doesn't work out. So that's why I like the stock market. And it's really not that hard to get into once you understand a few basic principles.
Appreciate that. And then you talked about the few basic principles, which I want to get to. But one thing that I wanted to ask is in real estate, you can leverage other people's money. It's kind of a great tagline investors like to throw around when they're marketing is no money down or use somebody else's money. Can you help us help educate us on how that's possible for an everyday person to use somebody else's money in the stock market?
It is very possible, but it's very expensive. So I'm not a real estate investor by any stretch, but I look at mortgage rates and they're pretty attractive. So, a couple percentage points of interest doesn't sound particularly debilitating from my perspective. When you
Right.
start to talk about doing that in the stock market, the brokers charge a lot and it's really not as attractive whatsoever. So I don't ever recommend trying to invest with other people's money when you're going into the stock market. And it's primarily for those reasons. The interest rates that the brokers will charge you, the commissions will charge you, the fact that if you go underwater on an investment and you're investing on margin, that's what it's called. When you borrow money from your broker to invest, it's called investing on margin. You can have something that's called a margin call, where if your investment goes down by a certain amount, the broker is going to call you and say, "Hey, you need to throw in $7,000 more to keep your trade alive. Otherwise, we're going to liquidate your account." Or even if you're stuck in there when the market crashes, they could just liquidate you anyway. So you really lose a lot of your power and a lot of the benefits of even being a long-term investor in the stock market if you invest in margin. So it's not a good problem, and it's particularly because of the way the stock market works.
Interesting. Yeah. What's your stance on things like mutual funds and index funds? It sounds like you pick individual stocks, maybe, but I'm just curious what you think about those funds. We hear some financial experts they recommend people get in mutual funds and things like that. I'm just curious what you think about them.
So there will be two differences, I guess. So let's start with the mutual funds versus index funds. Mutual funds compared to index funds on average are a lot more expensive. So again, we go back to, well, even if it's a 1% more expensive, you compound that over years and years and years, it gets to be very expensive. So a mutual
Right.
fund works where somebody's managing your money. An index fund is it's like an auto investment. If we take like the S&P 500 index fund, it's just going to buy every stock on the S&P 500. I really the way I approach it, because our podcast is really geared towards beginners, so I want people to go away from our show knowing that there's a few principles that you need to learn if you're going to be an investor. And that's regardless of whether you choose an index fund, a mutual fund, stocks, whatever the investment is, you need to learn those basic principles. Once we can establish that, then you can establish how much of a hands-on approach do you want to take. Do you want to try to buy individual stocks, or do you want to just, like I kind of mentioned at the beginning, let's just invest in the business world in general? And that's when you would just buy an index fund and let it sit and make sure you're invested for the long term. And you should do quite fine. For me, I found that I get fired up when I start talking about individual businesses, particularly when I can see them around in my everyday life. And I found that a lot of people get inspired that way too. And so for the people who are willing to take the extra effort, into picking individual stocks can be also very attractive.
I love it. Thank you for that. And when you talk about picking individual stocks, you mentioned earlier you kind of have to analyze that stock or that company or analyze a deal, if you will, putting it into real estate terms. How do you go about that? What is your thought process there? And I'm not asking for the secret sauce, but just kind of, if you were to educate somebody, say, hey, this is how I would look at it, what would you say?
Yeah, of course. Let's go back to what I was kind of rambling on when we first got on. Let's say I want to try to get into a company that's in the IT space. So if we bring it back to the big cloud companies, you have Amazon who does AWS, you have Microsoft that does Microsoft Azure, you have Google Cloud that does Google Cloud. um, let's say if I want to figure out about Amazon, you want to know what they do and basically how do they make money. And it's really it starts at that basic, and you don't want to go any further than that, and you don't want to gloss over that because it's very, very important. As an example with Amazon, when I hear people talk about it on TV or online, even doesn't matter, I think you hear a lot of people talk about the Amazon that we know that delivers packages to your door in blazing fast speed and has that smiley face on the box. But if you don't do some basic research on the business itself, then maybe you're not aware of the fact that they are in this cloud infrastructure space. And so that really kind of makes them a tech company. So those are the kind of things that you want to learn. And it's really, you start at the basics and then you move on to what are the competitors. And then you can start looking at some basic financials, like, do they make a profit? Do they have a lot of debt or a little bit of debt? And, maybe how is their cash flow, short term, long term? And those are the types of things you really want to look at. And they're very, very important. And I would not skip those steps for any stock I'm looking at.
Great. So in real estate, we are looking at risks associated with the deals we do. I'm curious how you kind of look at risks with stock market investing, and maybe how you sort of protect yourself from that.
Great question. I've really great question because people don't want to talk about it. I found
we do.
Good.
Real estate guys
doing a good service. It's so easy to gloss over that and just get really excited about profits, but really, really key that you understand what's the downside and what can happen and how am I going to prepare for it, right? So when I first started out in the stock market, I saw the exact same thing where everybody's talking about, who are the best businesses, how much have they made, how much has their stock grown in the past 36 months. Nobody's talking about, well, what about the businesses that do really bad? So I did some research. I looked at some of the biggest businesses that have gone bankrupt in the 21st century. And I went through, it was very meticulous, very laborious. 30 companies I looked at, and I wanted to see, are there any similarities? Can we pull anything from this data? So I just took their basic financials, made a bunch of spreadsheets, did a bunch of nerdy stuff on there. And I found the biggest takeaway I found was that if a company is losing money, that was the most common characteristic out of any other characteristic with all of these companies. So it sounds really, really simple, right? Like, well, yeah, if a business is losing money, it's probably not doing good. But that gets so far lost that, believe it or not, that's like a groundbreaking revelation. So from there, I look at, if a company has been profitable and it turns unprofitable, that's a huge red flag for me. Another one that's simple is I look at the debt, and it doesn't need to be some complex leverage equation, just how much debt do they have and how much of it is coming due, and that's something you can look up quite easily. And if it's too much, then you just pass. Those are two big, really red flags. That outside of that, just be diversified, and you do those two things, and you're way ahead of the game when it comes to risk management.
So when you say
Excellent.
diversification, is it more by industry? Is it stocks and bonds, a mixture of index funds and individual stocks? What's your vision there for diversification?
I would say it depends on the investor. So if you're somebody who's close to retirement, you probably want to diversify out of the stock market for all of the reasons that we've discussed today, where it's a very volatile place in the very short term. So you want to go somewhere where you're not going to see your portfolio value crash if the market crashes. So you would want more bonds.
Sure.
If you're somebody who's a little bit less hands-on, you would probably want a lot of index funds. And when it comes to somebody who's more hands-on, you do want industry diversification. I don't want to be invested in restaurants right before COVID hits. Of course, you can never predict that, but it would be a perfect example of what happens when you're not diversified. Anything can happen in the future. We just don't know. And that's why you try to split things up. I don't care if you're the best investor in the world. Nobody knows what's going to happen in the future. So you do that. And it is important to be diversified through industries. In my opinion, it's also important to be diversified through the stocks themselves, because anything can happen in the business world. I mean, we used to have desktop computers as the number one thing, and now so many people use laptops, even for work, which was unheard of even 10 years ago. So those are the types of things that you have to keep in mind, and that's why you put systems in place that are just fundamental principles of investing, and it will help you mitigate your risk, increase your chances for return over the long term, and really it helps you sleep at night too, knowing that you've accounted for the downside.
Nice. Now, Andrew, Kevin and I invest for cash flow. So we invest so that our investments will throw off cash flow monthly or maybe quarterly. And, that's part of what attracts us to real estate investments. How can you create cash flow with stocks?
Yeah, so we have what are called dividends. These are payments that these businesses will make to their stockholders, and you'll get that income every single year. So, it's not as attractive as a monthly income, but what's nice about, I think, cash flows in general, whether you're talking about real estate or with businesses or with investments in the stock market, is that if you just funnel that cash flow back into new investments, now you start to see those cash flows multiply. And again, it comes down to the math of compounding. And so with my dividends, I am constantly putting those back into new stocks or even the same stock that also pay dividends. And so you really get these streams of cash flows that start to multiply if you look at a river and it forks and it forks and it forks. And that's kind of what you're doing with the cash flows. And it can do beautiful, beautiful, beautiful things. In particular, in the stock market, you can reinvest in a stock, and then as that stock price increases over time, those little what seemed like tiny investments at the very beginning, those tiny bits of cash flow that you got, if you reinvested them in that stock, then those little shares become really, really big if the stock price becomes really, really big over the long term. And plenty of businesses do that. It's just really, you have to be patient and you have to reinvest those dividends. And that's how you can really get what the best benefit of the stock market is.
Okay.
That's great.
Yeah. Those dividends. And then if we understand, you're talking about kind of reinvesting those dividends is one option to kind of grow that little stream, turn it into kind of a raging river, if I understand correctly, because then it builds upon itself, gains momentum, and that dividend creates more dividends for you because you're able to buy more shares. Is that a correct summation?
Yeah, that's perfect. I like that raging rivers. It reminds me of like raging waters.
Perfect. Feel free to steal it. I'm happy to I'll take a royalty on that if you use it again.
Create your own cash flow.
There, create a cash flow for myself. When we were talking about the stock market, you mentioned that there's some basic fundamental principles that people should know before they kind of venture off into this world. I'm sure we could have an entire discussion around those, but what would you say are the three main ones that come off the top of your head?
I would say we've covered them already, and it's be a long-term investor, diversify your investments, and then reinvest your dividends.
Nice. That's great. I love how you have the foundation, the principles there. That's fantastic. I mean, we do similar things with our investing approach, and I think that's just a key principle to operate on there, to have that foundation. Andrew, what are some of your favorite resources for learning how to invest in the stock market? Are there books or a podcast? Of course, your podcast, I'm sure. Maybe others, and what kind of resources do you like for that?
I love podcasts, I love audiobooks, and I love regular books. So if I could give one book recommendation, it would be Beating the Street by Peter Lynch. Peter Lynch was a guy who ran Fidelity's Magellan back in, I think it was the 80s. And he was just one of the best mutual fund managers of all time. What I like about him is he really breaks it down and talks about the stock market on layman terms. So I mean, I could give the book to my mom, and she would totally understand it, not knowing anything about the stock market kind of in general. He talks about how his wife has given him stock tip ideas, where she went to a store and told him how busy it was. He checked out the financials and made a bunch of money on the stock. So I really like that one. It's great for beginners. And it was actually the first book I ever read when I first got started. It was one of those things. I went to the bookstore and I didn't know what to buy. And I saw his name, and his name was Lynch. And I was like, well, I know Merrill Lynch. That's probably going to be a decent book. And it ended up being a great book. And he ended up, being one of the best investors to learn from. I also like podcasts, and I think listening to a podcast like your guys's is going to be something that can be a winner for people. Or our show, we have a show we do weekly called the Investing for Beginners podcast. We answer listener questions all the time and talk about our principles all the time. And just, that, or audiobooks too. I remember when I first started out in the market, I had my group of maybe 2 or 3 podcasts, and I just listened to those religiously, and they were foundational in helping you just absorb the information. And it's not something you learn over time. You don't learn how to become an Olympic swimmer the first time you take swim lessons. Similar with any investing skill, you got to immerse yourself, and you start to just accumulate knowledge, and the knowledge really does compound on itself over time too. So I wouldn't try to get too caught up with trying to get like 50 resources all at once. Maybe take one resource, like your guys' great show, find your next resource, and then just build from there.
Thank you.
Yep. There's that idea of compounding and being in it for the long haul, right? The investors, the most successful investors, are the ones that have been doing it forever. They know that it's a game of patience. They understand that it takes discipline. So I love that. And that can be said about if you wanted to start. It doesn't matter how old you are too. If you want to just start learning and figure out ways to become better in that aspect. Totally love that comment there. Now, we wouldn't be the tech guys who invest if we didn't ask you about technology. And your background is electrical engineering. So we wanted to ask you, what is a piece of technology that you feel the stock market is missing?
I don't know if I have a good answer for that, just because it's really hard. The stock market feels like it has everything already. I guess maybe I would have to go to an entrepreneurial meetup and find somebody who's doing something incredibly different. But you would be surprised if you looked at the market, if you looked at whatever technology you're using, and you tried to find companies that either create that product or, provide that service or do something ancillary to that. You'll find that there's lots of companies out there who are navigating that, and it's not hard to buy those shares of those companies yourself and participate in those profits. I really, really like right now the stocks, the businesses that are helping companies that are wanting to become more digital and upgrade their IT systems. And I don't think you have to buy an Amazon or a Microsoft or a Google to do that. I think there are smaller companies out there with that potential that are still have a lot of room to grow. And it's something that people who are interested in can do some basic research and find some good stocks out there.
Great. Andrew, thanks so much for coming on the show. I mean, we're primarily focused on real estate, but we love having people like you come on occasionally and just kind of expand our view and help our audience and us learn about what other people are doing to invest and to create that financial freedom for themselves. So thanks so much for coming on and sharing your knowledge and your expertise and your time with our listeners. Now, if people would like to learn more or maybe connect with you, check out some of your materials, check out your Investing for Beginners podcast, where can they find out about you? And we'll put all this in the show notes.
Yeah, thank you. And thanks for having me on, Adam, Kevin. These were great questions. And it's great that you're doing that service to your audience to give them a diversity of opinions and ideas and letting them decide for themselves. And it's great when you can see other practices that use similar principles, because then you know that you're on the right track with the principles and values you're setting up for yourself, because the best principles and values are timeless and they span across expertise, and it's not just specialized to one thing. So we have a podcast. It's called the Investing for Beginners podcast. You can find us on Apple Podcasts. We also have a blog. It's called investingforbeginners.com. 4 of us right now contribute regularly to that. And we put out so much content you wouldn't even believe it. Those are really the 2 best places to find anything I'm working on. And hopefully somebody out there finds it valuable.
Awesome. Well, thanks again, Andrew. It's been great having you on.
Thank you.
What's up, TGWI Insiders? We'd like to talk to you about our big goal for 2021 that we're determined to hit, but we need your help to do it. Our goal is to get 250 positive comments and reviews on Apple Podcast. You can help us in less than 1 minute, even as you're listening to this podcast episode. On your phone or computer, you can do this in 3 simple steps. First, search for us on your Apple Podcast app. Second, navigate to our podcast page by clicking our logo. And finally, scroll to the very bottom where it says leave a review to leave us a 5-star review and a positive comment. You can also get these step-by-step instructions by going to tgwipodcast.com/review. It's fast, easy, and would help us a ton. Thank you for your continued support, TGWI Insiders.
That's it for this episode of Tech Guys Who Invest. This is Adam.
This is Kevin. Thank you so much for listening to this week's episode. Be sure to subscribe to the podcast for the latest episode updates and to receive additional investor insights to help you invest wisely and safely. You can join the TGWI Insiders community at tgwipodcast.com/subscribe. Lastly, we would love to connect with you. The best way to reach us is by sending us an email at techguyswhoinvest@gmail.com. Thanks, everybody.